Welcome to This Week in Crypto from K33 Research. Today is June 19th, 2026. A written version of today's analysis is available at k33.com/research. This week brought several developments that point in the same direction. Crypto markets are becoming more integrated with traditional finance and regulated market infrastructure. The clearest example is the arrival of perpetual futures in the United States, but the same trend is visible in asset management, regulation, and market structure. The US Commodity Futures Trading Commission, or CFTC, recently approved a Bitcoin perpetual futures contract from Kalshi and cleared the way for similar products from Coinbase. This is a significant development because perpetual futures account for most crypto derivatives trading globally, yet the market has largely remained offshore. Supporters argue that bringing these products into regulated US markets could improve transparency, strengthen customer protections, and allow American exchanges to compete for a market that already exists elsewhere. Critics, including CME Group CEO Terry Duffy, warn that perpetual futures have historically been associated with excessive leverage and speculative trading. The debate is likely to continue. But the important point is that one of crypto's largest markets may finally move onshore. If that happens, it could reshape the competitive landscape for US crypto trading and become one of the most important market structure developments in years. A related trend is visible in asset management. BlackRock, the world's largest asset manager, launched a new Bitcoin income fund that combines Bitcoin exposure with a covered call strategy designed to generate yield. The launch reflects growing demand for crypto investment products that do more than simply provide exposure to Bitcoin. Investors increasingly want products that fit into broader portfolio strategies. Yield-generating Bitcoin products are one example of how crypto investing continues to evolve toward more familiar financial structures. The discussion around tokenized assets is also gaining momentum. A proposal from the US Securities and Exchange Commission could remove some of the regulatory barriers that currently limit tokenized equities. Benchmark described the proposal as potentially the most important US crypto regulatory development of the year. The details remain uncertain, but the broader significance is clear. Tokenized stocks are increasingly moving from a niche concept toward a serious discussion about the future of financial markets. In Europe, regulation remains front and center. Binance could face disruptions to its European operations if reports about its MiCA license application being declined prove correct. The timing is notable, coming just weeks before the European Union's July 1st MiCA deadline. Whether Binance ultimately secures approval or not, the story highlights a broader reality. Access to major markets increasingly depends on regulatory approval and compliance. That is becoming a defining feature of the industry's next phase. Finally, macro conditions remain important. The first Federal Reserve meeting, led by Chair Kevin Warsh, delivered a more hawkish tone than many investors expected. Rates were left unchanged, but the message was clear. Inflation remains a priority, and markets should not assume that easier monetary policy is around the corner. For crypto investors, the takeaway is straightforward. Even as the industry develops its own infrastructure and regulatory frameworks, liquidity and risk appetite remain heavily influenced by the broader macro environment. To summarize, this week's developments all point toward a more mature crypto market. Perpetual futures are moving onshore in the US. Asset managers are expanding their product offerings. Tokenized assets are attracting greater regulatory attention. And market access increasingly depends on compliance. Thank you for listening to This Week in Crypto from K33 Research. Subscribe for future market updates and visit k33.com/research to read the full report and explore our latest research.